All right, all right, all right. Here we are. It is officially Fed meeting week, March 15th and 16th, 2022. The Fed is meeting for a couple days, and generally they have 2 days of meetings followed by a press conference where the press is allowed to ask Jerome Powell questions. As much as we get information from the meeting itself and the meeting minutes, which people read through and report on, we probably get more information, especially about future plans from the Fed, from that question and answer session with the press. What Jerome Powell says, how he says it, is going to be an important factor on what the markets do as far as mortgage interest rates are concerned. All right, before I jump into it, mortgage broker who deals with thousands of clients on a yearly basis. I talk to hundreds of real estate agents month in and month out. I'm going to give you my hot takes, what I feel is going on in the mortgage market, in the real estate market, what you can do as a consumer, whether you're a first-time buyer, whether you're an investor, whether you're a move-up buyer, whatever the case may be. I'm just going to give you honest feedback of what I'm seeing, feeling, and hearing. So let's jump into it. Let's first and foremost talk about the Fed meeting. Much anticipated meeting. There's been a bunch of back and forth over the last few months. Is Jerome Powell going to raise the Fed funds rate 25 basis points? Is he going to raise it 50? What's he going to do? How does Ukraine and Russia play into it and change his plans? How does inflation readings change his plans? All that stuff, right, plays into what he does with the Fed funds rate, what he does trillions of dollars in mortgage-backed securities off of the Fed's balance sheet and the future plans for that. And this all affects, whether it's directly or indirectly, really doesn't matter, the 30-year fixed rate mortgage, right? And so that's what people who I'm talking to on a daily basis want to know. They don't really care about all the inner workings of monetary policy, the why, what, the how. They don't want to know how the watch works. They want to know what time it is. So I'm here to tell you the time is rates are headed up. They're headed up. It's almost a foregone conclusion. And I made a video last week talking about my predictions for the rest of 2022. We continue to see days like we saw today. I'm recording this on March 14th on a Monday. It was a nasty day. And I'll show you what happened with mortgage bonds here. This 63 basis point hit means rates got worse. 73 basis points, you can call that about an eighth, somewhere between an eighth and a quarter on interest rate. Somewhere, these charts that track daily averages throughout the country, I saw the number 4.41. That's their average nationwide 30-year fixed rate mortgage. And I honestly think that they've got like 0.4 points attached to that, which some people may find hard to believe. Know that, depending on the lender, you may be working with a mortgage broker who offers a lower rate. You may be paying less points or more points. But to know that rates have relatively quickly got up into the mid fours, I don't think that it's necessarily a bad thing or something that people should be overly concerned about. It just is apt to have more of an effect because of how quickly rates have gone from, look, this was August. This was 7 months ago, 2.7 to 4.41%. So I'll spare you all of this article and just say that everybody expects a 25 basis point increase from Jerome Powell after the Fed meets on Tuesday and Wednesday, the 15th and 16th of March. I think that the stuff that we want to watch out for, because a lot of this stuff, it might very well just be a foregone conclusion. We already know that that's happening. And so even in the article, a 1/4 point hike is considered a done deal. What he says on Wednesday, and this is 2 p.m. Eastern on Wednesday when they release the policy statement, and then 2:30 p.m. Eastern, he's going to have a press conference. That press conference, like I said, is going to be an interesting one. You could sit in front of a computer that tracks mortgage-backed securities and watch the volatility. 11:30 Pacific Standard Time for me, based on his conversations and what he says, what their plans are. We're going to do this or we're going to do that. We're going to be more aggressive or less aggressive. We're going to wait on stability and until we've got more certainty around what's going on geopolitically and Ukraine and Russia and all that other stuff. He might say that. He might say that he understands inflation is spinning out of control, 7.9% as of the last reading, and probably even higher. And he's got to take more aggressive action, right? If he says stuff along those lines, or does a 50 basis point hike, or alludes to the fact that they're going to do more aggressive hikes or more aggressive trimming of the balance sheet, is what they call getting rid of these trillions in mortgage-backed securities sitting on the balance sheet, that is going to have a direct impact on mortgage rates. And it's another reminder for folks who might be on the fence thinking about, right now I'm talking to more purchase buyers and I'm talking to refinance folks. Maybe I'll wait. Maybe this will subside, or maybe rates will go down. Maybe home prices will go down. I don't know what word to use. Implore you to, if you're in a position to buy, willing, able, and it's the right time for you and your finances and your family to buy a home, I just think that waiting, you're going to get hit with more of the double whammy that people have already been hit with. Increasing prices and increasing rates. Can both go up forever? I don't think so. I think there is an inflection point, but here's something that I think a lot of folks should think about. If you look at 4.25% and a $500,000 house today, and you say, you know what, I can afford it. It makes sense. It fits in my budget. It's in the neighborhood me and my family want to buy in, but I'll wait. Because I think that affordability is going to be an issue. I think that the economy might, find some turbulence and things might decrease in price. What very well could happen with the amount of demand that we've got built up and the amount, the shortage of inventory of supply that we've got, is we could very well watch home prices. Let's not get crazy. Let's call it 10% appreciation in 9 months. So let's say you buy in early 2023 instead of today. Or at least for our conversation's sake, let's say they go up 10%. So now you're looking at a $550 price and rates are at 5%. And since they've been steadily increasing, they've gone up to 5% and home prices have gone up, less people can afford it. So the market flattens out. Best case scenario for you as a person who waited, prices start to fall. Prices go down 10%. Hooray. Up to 550, and then 6 months later, 9 months later, they're down 10%. So now we're at 495. Well, 495 when home prices today are 500, essentially the same, $5,000 discount for you. That 0.75 difference in rate, because it's 5% then and it's 4.25 now, is a big difference. Just, ballparking it, let's call that $300 a month, $300 or $400 a month. It's not something that I believe is a good strategy for folks. And I think that you should be very careful if that's the game plan, right? I don't want to get too long-winded, but I would be careful. But back to the whole thing about today's video is just to highlight the Fed's meeting. Rates are going to be extremely volatile. If you like it, lock it. We've seen this volatility like we've never seen before, where the 10-year treasury, which we can count on the mortgage rates tracking that fairly well, has gone from 1.7 to 2.14. March 7th was a week ago. It's gone up 44 basis points in a week. That is insanity. The 10-year doesn't move that much. So I think it's, like I've said in the past, and I'll probably be repeating the same words, beating the same drum. All signs point towards higher interest rates. It just is what it is. Like it, love it, hate it, whatever it is, it's what we've got in the future. So I think the overwhelming question I get from people is it a good time to buy? If you're financially able and it makes sense for you and your budget and your family, it's a good time to buy, irrelevant of what the market is doing. You're getting into a 30-year fixed rate mortgage and you're buying a stable asset like real estate. We're not talking about adjustable rate type things. We're not talking about volatile assets, like other investments that people seem to be getting into today. We're talking about real estate, and we're talking about a 30-year fixed rate mortgage. If it's in your budget and you've got a stable job, it's a pretty safe bet, whether it's now, whether it's next year, whether it's a year after. So that's that. Thanks for watching, guys. If we can answer any questions at all, we're more than happy to help. Go to greatmortgagebroker.com, fill out a form, let us know where you're at, how we can help, and we'll be in touch soon. Till next time, we gonna see.